Hi everyone, I want to share with you the most exciting, enthralling, enticing pieces of market data over the past week. And if you think it is impossible for the stock market to be interesting, are you wrong? So let's start off with what these are. The first thing I want to share with you are, like I said, the most interesting of all of these slides. And no, it's not this one with my face still on it. It actually relates to this. Now, I thought this was absolutely fascinating because, first of all, it gives me a bit of a relief that we're not going to get a downward turn. We've had a great, 18 months with the markets, in terms of the markets going up and up and up and up. Of course, what the markets do doesn't necessarily mean it's great for everyone. But certainly, this retail investors, basically you guys watching this, who are buying into any dip. So that's been good. Also, well, it's sort of mixed news from Morgan Stanley here, which is the price earnings ratio of the S&P, which is a measure of valuation. Okay, the forward 12-month PE for the S&P, they think it's mid-cycle with some PE contractions, 20% on average. Essentially, what they're saying is you could see the S&P fall back about PE have 12% to fall, which means the S&P could have some downward moves. Well, it doesn't take a genius with a PE calculator to say that, but essentially it's their way of talking about valuations. I'm going to come to that in a second in terms of valuations and make it into more user-friendly language. But essentially, they think price earnings ratios could fall back. In other words, profits could stay the same. It's just that we're selling some stocks nevertheless, and therefore the price of those stocks drops, the multiples drops, and that could result in obviously the S&P potentially falling, not because profits are falling, but just simply because at this level where we are in the cycle, people start taking profits, selling some of the S&P that they've had to date. So I ask people, is it time to sell stocks for the rest of 2021? You might think, well, there's not much left, Alpesh. This poll was taken about a week ago. 566 people voted. It's pretty much 50-50. I know quite a few people have said, I'm going on holiday. I've had a great year. That's the end of that. That was posted on LinkedIn, so obviously it's a small audience. Memories of this. How did that get in there? I deny everything. No profits, no problem until now. Goldman Sachs have published this, and what they are basically looking at is, well, up till now, if your company wasn't profitable, it didn't matter. Okay, this is the Goldman Sachs non-profitable technology index. In other words, the index of stocks which aren't making profits. That's getting hit. I think people are starting to get out of companies which aren't making profits into those which are, because it gives them more security in an overvalued market. And certainly all of the companies I've invested in are profitable. This reminder, 24th of November 2018, so 3 years and 2 weeks or 3 weeks ago, 3 years and 3 weeks ago, I'd written this. Every single one of those stocks, I said, whilst it was down between 40% to as little as, 20% in the case of Alphabet, these returns will be made back. And therefore, you'd have 33 to 50% returns when they return to their previous peaks. They did that relatively quickly. Okay, I'm less worried when it comes to high profitability quality companies. I'm going to exclude Netflix for the moment, partly because in my list, I've got Alphabet, Amazon, Apple, Meta or Facebook, and Microsoft are the ones that I tend to focus on. And again, goes into that thesis of retailers buying dips as well. Okay, this isn't just retail, but the institutions, and those are one of the things you might find surprising is that's how far they can fall, and without the panic of ditching those stocks, the simple reason they return to where they were. I was at Oxford this past week. The reason I want to show that is, other than sort of caught me not looking silly for a change, was this. I've changed my shirt since then, I should say. Was this. That's when I really started to focus on investing full time. When I finished my university course, not last week, but when I finished my university degree in the mid-90s and spent the summer over there. And it was a great reminder to go back to all of that. And the fact that I try to mix Nobel Prize winning economic research, like the type that I get from, sort of that I read from people like Daniel Kahneman or Eugene Famer, or Richard Thaler, none of whom were my tutors at Oxford, I should say. They weren't at Oxford, but there are other Nobel Prize winners there. The academic stuff with the stuff coming out of the hedge funds and that kind of research, or a Goldman Sachs and the investment banking research, with, of course, my own. And I think that's critical, not just looking at journalist comment, which is what most retail clients do, I'm afraid. When I was at Oxford, or 6 years after I left, I was elected rather, a visiting fellow in business at Corpus Christi College at Oxford. And one of the areas I used to lecture on to the students was this area, behavioral finance, connecting the biases which you're all familiar with, or the logical fallacies as well as biases, and converting those into the language of finance, and how does that affect you in finance. Now, as social media expands, it's going to be more important people know about these things. So I want you also to be aware that finance is one thing, economics is one thing, but actually the psychology of it is probably the most important, that intersection. US before corporate profit. So here, this is US before tax corporate profit. So American before tax corporate profits, they've been going exponential. The reason I mention this is from the Bureau of Economic Analysis. The reason I mention this is because if profits or earnings continue growing, then there is a very good reason why the market capitalization or prices of stocks should also rise. It provides a buffer or a bottom to stocks. Again, we're going back to profitable stocks being the ones that we probably want to be in. This is before tax corporate profits as a share of GDP. Now, everyone talks about this Warren Buffett indicator, the CAPE indicator, and they say GDP to market cap, for instance, and CAPE separately, and the cyclically adjusted price earnings ratio. And I say, well, actually, what's more important, I think, is the before tax corporate profits, even after tax, as a share of GDP. And why? Well, it's profits which are more important than market capitalizations, for instance, or anything else. And it's profitability that you can see here, which tells us, well, what's real? Actually, you could even say cash flow is more important than profits, but that's a separate discussion to be had. Yes, we're somewhat overvalued. We could easily drop back a little bit and not harm ourselves. So wanted to show that. Consumer price index inflation, everyone's talking about inflation. Where is it? Yeah, it is actually jumping up a fair bit. That's the data on it. I'm not going to speculate what might happen if interest rates rise, because even if interest rates rise, earnings, do you see what I said about earnings? They're so strong that they would trump the headwinds that higher interest rates would bring, because you've got the tailwind of high earnings. Okay, this is that Morgan Stanley data. It's sort of slightly more broadly. Mid-cycle normalization of P's is resuming lower with Fed tapering faster. What they're essentially saying is around this time in a cycle, you'll get the price to earnings ratio, so the share price relative to profits of the company, that number diminishing. If that number diminishes somewhat, then as people get more cautious, get a bit concerned, also with less support from the monetary authorities as well, in terms of less money coming into the market, then what tends to happen is, even with the same level of profitability of a company, its share price would still drop because the PE ratio has dropped. That's a complicated way of saying you got to discount the earnings somewhat, essentially. So whilst I did say earnings are rip-roaring, they are. Don't expect the kind of tailwinds we've had up till now. You guys, well, I didn't need that data to tell me that. Common sense would have told me that. Fair enough. I leave you with this one, and a Merry Christmas, which is seasonal performance. Now, I was quite surprised that December is as poor as this, because I thought, everyone talks about Santa Claus rally. And again, it shows you what's important in terms of what people talk about and what the data shows. I guess one thing COVID's taught us is look at the data. If we look at the data on this, I could understand why, going back to that poll I did on LinkedIn, you may well think I'm going to take December off. I'll just start in January, because January tends to have, 4 times better average returns than December. Why the heck do I want to play around in December? In fact, you might say, screw it. Given what happens in February and March, I'll just start in April. Okay, buy in April and then go away till, I don't know, November. There's an idea. More of these charts in future broadcasts. I hope you found all of that very helpful and useful. If you do, leave me comments wherever you are. Also, have a look at my campaign for $1million.com, which is to teach 1 million people how to be better investors, all the way from the more hardcore economic stuff that I've put in here and linking it to psychology and investing to the more sort of regular retail stuff. But I hope you will follow that channel as well. Go to campaignfor1million.com. You'll see my free Telegram channel where you can see a lot of this data as well. And download my books from there for free. Thank you very much.